question 2, we have solved the A part. Excuse me. We still have to deal with the B part and the C part. The topic, option theory and valuation. Like we explained, is about option markets. An option market is a market where you can buy or sell options. What is option? Option is the right to buy or sell an asset at a pre-specified price within a specified period or on a particular future date. You can obtain the rights to buy an asset at a future specified date. You can obtain the right to sell an asset at a price agreed today on a future specified date. The right to buy is known as the call option. The right to sell is known as the put option. The predetermined price is what we call the exercise price. Now, to obtain this right, to obtain the right to buy or to obtain the right to sell, you must pay a premium. This premium is the price or the value of an option. This premium must be paid immediately, and the premium is non-refundable. To calculate the premium, you can use the Black-Scholes option pricing model. We explained that Black-Scholes is a mathematical model that can be used to determine the fair price or the theoretical value of a call or put option based on 5 input variables. The 5 input variables are the underlying asset price, the exercise price, the risk-free rate, time to maturity, and the volatility. The volatility is measured by standard deviation. We explained the call, the formula for call price, the formula for put price, we explained the put call parity theory. The puts call parity theory. This is a fundamental parity relationship between the price of a call option and a put option. You can use this equation to determine the call price or the put price. We explain the Greeks. The Greeks measure the sensitivity of option price or option value to a change in interest rates. Excuse me, please. We have the data. Data is one of the Greeks. Data measure changes or change in asset price. Data measure change in option value as a result of change in asset price. We explained that the data of a call option is ND1. Data of a put option is ND1 minus 1. Data of an asset is 1. We explained that data can be used as an hedging tool. You can use data to hedge against fluctuation in your investment value by creating a portfolio. A portfolio containing assets and options. We look at the gamma, theta, rho, and beta. Then we try to solve questions. Between last week and now, any question, please? All right, let us go to question 2. Now we can round up question 2. We take a reading of the question again. Question number 2. An investor owed 500,000 shares of Benko PSC and is considering buying some put options to hedge our investment. Benko's current share price is 60 naira. The risk-free rate is currently 12%. Recent volatility in bracket standard deviation of the shares has been 30%. She requires European put options with an exercise price of 50 naira and expiry of 2 years. Requirement A says calculate the value that a bank is likely to charge for 500,000 put options of the investor's required specification. We calculated this last week. Recap our calculation last week. For requirement A, our ND1 was given as 0.8864. That was the figure we got for our ND1. Price per put, our calculation, our put price, put option price is calculated to get 1.71. The total put price, total put option price. We calculated this to give us 500,000 put options multiplied by price per put, 1.71. We got 855. $855,000. Those are the figures derived from our calculation of requirement A. Now we shall move to requirement B. Requirement B, examiner says, is the investor's position 500,000 shares and 500,000 puts bracket close edge? If yes, explain why. If no, advise on the number of puts needed for proper hedging. Now let me explain this aspect. The investor has 500,000 shares in a company. To protect herself, she now purchased 500,000 put options. She is looking at it that a put option should equal to 1 share. One put option should be sufficient to protect 1 share. That is our own belief. But that belief is wrong. One may not be equal to 1. At times, you might require more than one put option to protect one share. For us to determine the number of put options needed, you must introduce the data. Data is used as an hedging tool. This investor has not introduced data. She has just assumed that because I have 500,000 shares, let me purchase 500,000 put options. So, to respond to this question, if you look at question B, you have two questions in B. Examiner says, is the investor's position 500,000 shares and 500,000 put hedge? If yes, explain. So the appropriate response to that question is to say no. Investor's position 500,000 shares and 500,000 put options is not hedge. That will be our response. If you move to the whiteboard, and I need to respond to B, my response will be the investor's position bracket open, 500,000 shares and 500,000 puts. Bracket close, is not hedge. Is not hedge. This is because data of the put option is not taken into consideration. I've answered that first aspect. The first aspect of question B, we have answered it. Now, if no, advise on the number of puts needed for proper hedging. When I come here, the number, let me take this off small. The number of put options, number of puts options needed for proper hedging is calculated below. Calculated below. Assuming number of put option is equal to X. So we can now go to below. Please look at below. For you to talk of hedging, you are going to create a portfolio. Look at the portfolio. A portfolio of assets. Our asset is stock. This investor has shares or shares. Our asset is the share. Then option. The option we are dealing with is put option. So you are going to create a portfolio of shares and put option. Then you have the quantity, data, then the total data. Total data. Now we start with the shares. How many shares do we have in this company? We have 500,000 shares. How many put option do we require? We don't know it yet. That is what we are trying to calculate. So we represent this with letter X. Next column. Data. Please, what is the data of an asset? An asset could be shares, stock, or bond. Now we are dealing with shares. What is the data of an asset? I'm asking a question. What is the data of an asset?
One.
Correct. The data of an asset is 1. Therefore, 500,000 multiplied by 1. Total data is 500,000 here. We move to put option. What is the delta of a put option? What is the delta of a put option?
-1. I don't know.
ND1 -1.
Thank you. ND1 -1. There's no room for guessing. We stated this. Delta of a call option is ND1. Delta of a put option is ND1 -1. Delta of an asset is 1. It will never change. We now come here. Delta of a put option is ND1 -1. I can go down small. Delta of a put is equal to ND1 -1. And we have calculated ND1 to be 0.8864 -1. Please calculate delta of a put option. That will give us negative 0.1136. We now go back. Delta of a put option is negative 0.1136. We now multiply x multiplied by negative 0.1136. That will give us negative 0.1136x. You now sum. When you sum these two, the total delta to achieve neutrality. You know, when we explain delta neutral hedging is used to protect investment against fluctuation. Now, to achieve neutrality, your total delta must equal to 0. To achieve delta neutral position, total delta must be 0. Therefore, if we sum these two, it must give us 0. So what is x? That is what we are trying to determine. What is x? We can move down a bit. This is working. Let's circle this out. This is working. So if you move down a bit, 500,000 plus brackets minus 0.1136x should equal to 0. If I open the bracket, this becomes 500,000 minus 0.1136x is equal to 0. We can collect like terms. Negative 0.1136x is equal to, if 500,000 is moving over is equal to, this will give me negative 500,000 negative, we cut out negative. We are now left with our S is equal to 500,000 divided by 0.1136. Please compute. What do you have? What is X?
4,401,408.
4,401,408. This is the number of puts needed. Number of put options needed. I don't. Needed for proper hedging is 4,401,408. This is the requirement. This is solution to requirement B. Please, in exam, if examiner is talking about hedging under option theory, you must introduce the data. Examiner will give you assets. Assets may be stock or shares or bond or foreign currency. Examiner will now ask you whether to hedge with put option or to hedge with call option. Remember these 3 points. The delta of a call option is ND1. The delta of a put option is ND1 minus 1. And the delta of an asset is 1. We are done with requirements B. We now move to requirement C. Requirement C. Refers to position in A. Calculate the investor's change in wealth if she buys 500,000 put options to hedge her portfolio, and the share price in 2 years' time is, Roman figure 1, 30 naira per share. Roman figure 2, 100 naira per share. Change in investors' wealth. Let's go to the solution. We explain this with the solution. We have two scenarios here. Requirement C. We have scenario 1. Scenario 1. Change in investors' wealth. If share price in 2 years' time, 2 years' time, 2 years' time is 30 naira. Now you have two different markets. We have the stock market, where the investor can buy and sell shares. And we have the option market, where you can take options to protect your investments. I will restate that. We have two markets involved. We have the stock market, where the investors buy and sell shares. We now have the option market, where the investor hedge against risk. Now, look at it, please. Currently, the share price is 60 naira. If in 2 years' time, the share price happens to be 30 naira, what has happened to your investments? Let me repeat that. You can take yourself as the investor. Currently, your investment per share is 60 naira. And if in 2 years' time, the price per share happens to be 30 naira, what has happened to your investment?
Decrease in value.
Thank you. There's fall in value. There's loss of value. Look at it, please. From the stock market, the investor will suffer loss. Loss. Currently, share price is 30 naira. Sorry. In 2 years' time, share price happens to be 30 naira. And now, currently 60 naira. That means the investor will lose 30 naira per share. If scenario 1 should happen, the investor will lose 30 naira per share. How many shares does these investors have?
$500,000.
500,000 shares. That means the investor will suffer reduction in investment value multiplied by 500,000 shares. If you multiply this, you are going to have 15 million loss.
Yes.
Investor will suffer 15 million loss in her investment value at the stock market. She doesn't have control over that because the investment that was 60 naira per share has fallen to 30 naira per share. So the investor will suffer 15 million naira loss at the stock market. We now move to the option market. Now the investor has taken an option. The investor has taken an option. She has obtained a right to be able to sell her shares at a predetermined price. That predetermined price is 50 naira per share, the exercise price. The investor has taken an option to sell her shares for 50 naira per shares in 2 years' time. Now the question is, imagine you are the investor. You have obtained a right to sell your shares for 50 naira per share in 2 years' time. On getting to 2 years at the stock market, the share price happens to be 30 naira per share. And you have obtained a right to sell at 50 naira per share. The question is, will you exercise your rights to sell?
No.
Yes. Yes. Yes, you
Yeah.
will.
Say yes or no.
The correct answer is yes. You are going to exercise your rights. You have obtained a right to sell for 50 naira in 2 years' time. On getting to 2 years, the share price happens to be 30 naira at the stock market. You are going to exercise your rights. You are going to sell for 50 naira. What's currently worth 30 naira? You are going to make a profit. You are going to make a profit of 20 naira per shares sold. Look at it, please. At the option market, profits on option. You are going to exercise your rights. This is equal to the exercise price is 50 naira. The current share price is 30 naira. That means you are going to make a profit of 20 naira multiplied by number of puts. How many puts do we have in this transaction? As we look at it, if she buys 500,000 put options, that means I'll come here, multiply by 500,000 put options. Work this out. There's going to be profit of 10 million coming from the option market. Can you see it? The investors suffer loss at the stock market, but achieve profit at the option market. You now introduce the put option premium.
That is the cost. The cost of
Thank,
obtaining the option.
thank you. The put option price or premium now. Thank you. We call it put option price or premium. Thank you. You are following this now. We calculated the put option premium to be 855,000. This premium must be paid whether you exercise your rights or not. You cannot calculate change in words. 15 million negative plus 10 million, that will reduce it to 5 million. Then another negative, the change in weight becomes change in weight, change in investors' weights, is equal to negative 5,855,000. That is the change in the investors' weight. For scenario 1, this is the change in investors' weight. Investors' weight will reduce by 5,855,000. Just 1 minute, please. Now let's continue.
Sir, please, can you scroll up?
Excuse me,
I just want to
please.
see I just want to see the workings.
I will.
I have a question, please.
Yes, I will, no problem.
No, I have a question.
All right.
My question, I hope it doesn't slow our work down. My question is, I don't understand why this 5.855 is considered a change in investors' wealth. What I'm asking is, the investor is not going to exercise or decide these two options, two scenarios. They are alternatives. So if the investor is losing in the stock, the investor, if they take the option, they will not lose in the stock market. If they lose in the stock market, they will not take the option. So I don't understand why we are combining it. So, so the option market and the premium are together, while the stock market is an alternative. So that is a part I don't understand why we're combining all of them, because they are alternatives. Thank you.
Okay. Now, yeah, no problem. Assuming you are the investor, you purchase some shares. You purchase 500,000 shares at the rate of 60 naira per share. That means you parted with your money. You have an investment. You have invested in company shares. You purchased 500,000 shares at the rate of 60 naira per share. Now you are planning to sell these shares in 2 years' time. You now approach the option markets to obtain a right to be able to sell your shares at 50 naira per share. That 50 naira is the exercise price.
I think I get it now. I think I got it.
No, it's fine that you ask, because you also
Yes, I've gotten it.
No, it's good. I will still continue with the explanation, because some people might not ask questions, but they are not even getting it 100%. So any opportunity we see to explain more, we explain. So let's follow the scenario, or the illustration we are trying to create. So imagine you are the investor. You invested in company shares, 500,000 shares, and you bought the share for 60 naira per share. You plan to sell these shares in 2 years' time. You now approach the option market to obtain a right to be able to sell your shares at a predetermined price agreed today. Now you agree to sell your shares for 50 naira per share. You obtain a right. Now to obtain this right, you must pay a premium. This premium is non-refundable. Now the option market will compute the premium. The premium was computed and you are required 55,000. You pay the premium. You now waited until 2 years' time. When we get to 2 years' time, at the stock market, the share price happens to be 30 naira per share. That means that share price, your investment at the stock market has suffered reduction in value. Your investment will reduce by 15 million naira, because you have gotten the share for 50 naira per share. So your investment will reduce by 15 million naira. Now, because you have obtained option to sell, right to sell, you have obtained a right to sell for 50 naira per share. And the share price at the stock market happens to be 30 naira per share. As an investor, reasonably, you should exercise your rights. Sell those shares for 50 naira per share. That means when you are selling, what was 30 naira, you are selling for 50 naira. You are going to get a profit of 20 naira on each. Now you have taken 500 put option. That will give you 10 million profits. We now consider the three items. Now, to appreciate what the investor has done, assuming the investor has not taken option. If you have not approached the option markets to obtain a right to sell your shares, that means transaction 2 will not happen. Transaction 3 will not happen. If the share price happens to fall to 30 naira, the investor will suffer 15 million loss. But by taking option, by taking a right to sell your shares, the investor's loss has been reduced to 5,855,000. You can see that option market can be used to reduce the risk of fluctuation in investment. I hope the explanation is clearer.
It's fine, thank you.
All right, you're welcome, please. We can look at the second scenario. Examiner gave us two scenarios. Scenario 2. Scenario 2. Calculate change in investor wealth if share price in 2 years, in 2 years time, 2 years time is 100 naira. Again, remember you have two markets involved. You have the stock market where investor can buy and sell shares. Then we have the option market that can be used as an hedging market. We have the option market. Now, currently the share worth 60 naira per share. Now, if in 2 years' time, the share price is now 100 naira per share, what has happened to your investment at the stock market? That investment has appreciated in value. Is that not, please?
Yes.
That means the investor will make a gain. 100 naira, the price now, that is 2 years. The price happened to be 100 naira. But currently, it was 60 naira. That means the investor will make a profit of 40 naira per share. The investment value will increase. Multiply by number of shares, 500,000. The investment value will increase by 20 million. This will happen at the stock market. Now we move to the option market. At the option market, you have obtained a right to sell your shares for 50 naira per share. in 2 years' time. You obtain a right to sell your shares in 2 years' time for 15 naira per share. When we get to 2 years, the share price at the stock market is now 100 naira per share. Now the question is, will you exercise your rights?
The investor will not exercise the right.
Definitely. The investor should not exercise his rights. Because if you exercise your rights, you are going to sell for 50 naira. What currently worth 100 naira? In this case, you are going to walk out of that. It's an option to sell, not an obligation. The investor will opt out. Investor will not exercise our rights. In this case, we are going to have near. But whether the investor exercises his right or not, the premium must be paid. Now come here. Put option price or premium. Or premium, that is 855,000. We can now get the change in words. $20 million minus 855,000. That will give us 145,000. This is changing investors' words. We are done with the question. We are done with the question. Any question, please? Right. Please, let's give this topic attention. Just 1 minute. I'm trying to add information to this so that we can continue the class. Okay, let's see. Okay, synthesis. Now, what we have looked at is the introduction to option theory. We now move to application of option theory to investment appraisal. The application of option theory to investment appraisal. The addition we are adding to, we are discussing tonight is identifying real options in investment appraisal. Option theory can be adopted in evaluating capital investment projects. The concept of option theory can be used to value investment appraisal. Normally or conventionally, investment appraisal or investment projects is evaluated using net present value, internal rate of return, the payback period method, modify internal rate of return. In most cases, the net present value is regarded as the superior investment appraisal technique. And this method is always used or is preferred when evaluating capital projects. Now we can use the concept of option theory to appraise capital projects. How does this work? Is to identify real options in investment appraisal. Option theory provides flexibility in valuing capital investment projects. It enables us to be able to value financial flexibility. Option theory is able to look at some of the deficiency of the conventional net present value method of investment appraisal. If you look at the net present value method, it completely ignores financial flexibility. What do we refer to as financial flexibility? Option theory assumes, conventional net present value appraisal method assumes that a project must commence in year 0 and end at a particular period. If you start a project in year 0, you must take that project to completion. The question is it a must to start a project in year 0 and complete it? Conventional net present value ignores financial flexibility. And this is what option theory is bringing to the valuation of investment. If you are looking at real options, we have like 3 areas. There are like 3 areas or 4 areas of application where you can apply option theory to investment appraisal. We have like 3 or 4 areas. One is option to abandon. One is option to abandon. What is option to abandon? Unlike the conventional capital investment project analysis that assumes that a project must be taken to its logical conclusion. It assumes that if you are calculating NPV, the assumption is that we start a project in year 0 and we are going to take it to the final year. But it is not a must to take a project to final year, particularly if that project is not giving us the expected return. For example, you have an investment that will cost 500 million at commencement. Commencement is year 0. An investment will cost you 500 million. You now do a projection, an estimate. You do a projection. Expected cash inflow in year 1, expected cash inflow in year 2, year 3, year 4, up to year 5. Based on this cash estimates, we now calculate the net present value. If you look at it, really, the only thing we are sure of is the amount we are committing to the project at the commencement of the project. We are only sure of 500 million. Other project variables are estimates. We have estimated cash flow in year 1. We have estimated cash flow in year 2. We have estimated cash flow in year 3, up to year 5. Now let's assume we now commence the project in year 0. Year 1, year 2, our estimated cash inflows are not realized. Year 1, year 2, year 3, our estimated cash flows are not realized. The question is, should we continue with the project or should we abandon the project pathway? Under option theory, the investor has an option to abandon the project. It is not a must to take that project to the final year, particularly if the project cash flows, cash inflows are not realized. We can abandon the project. This is the concept of options to abandon. An option to abandon is treated as a put option. The right to abandon the project pathway and sell the project to another investor. Option to abandon is treated as a put option. That is the right to sell. If you are faced with question on option to abandon, you have 3 steps. If you are faced with question on option to abandon, you have 3 steps on how to treat this question. We are looking at option to abandon. Abandon. Please note, this is treated as a put option. You have 3 steps when dealing with option to abandon. Step 1, calculate NPV without option to abandon. Without option to abandon. Calculate the NPV of the project without the option to abandon the project. Step 2. Step 2. Calculate put option value. That is the price. In this case, the input variables are represented below. Look at below. XO. Underlying asset price. The underlying asset price is equal to present value of future cash flow foregone. Present value of future cash flows foregone. Your E, the exercise price, is equal to the salvage value of the project. Salvage value of the projects. That is the scrap value of the project. Your T, time to maturity, is equal to year of abandonment. Year the project will be abandoned. Year of abandonment. Abandonment. Your R, the risk-free rates. Risk-free rates. As given. Examiner will give you this. As given. Then your standard, your volatility. In bracket, standard deviation. Examiner will also give you this. This will happen in your step 2. Your step 3. is equal to calculate net present value with option to abandon the project. With option to abandon. This is equal to value of put option, value of put option plus MPV without option to abandon. Without option to abandon. Your step 3 is addition of step 1 and 2. These are the steps involved if you are dealing with question on option to abandon. These are the steps involved. Let us take illustration to this. Look at question 1 on option to abandon. The question says, Switch Company Limited is considering a high-risk project with the following after-tax cash flows. Look at the cash flows for year 0 to 5. In year 0, the initial cost 930 million. When we have cash flow for year 1 to 5, 120, 160, and what have you. Next, the risk-adjusted discount rate is 12%. The company has recently received an offer from a foreign investor to buy the entire project for 620 million at the start of year 3. Look at this project. The project is for 5 years. Now, a foreign investor is offering to buy the entire project for 620 million at the start of year 3. That means the company in question, Switch Company, has a choice to sell this project at the beginning of year 3 without taking the project to year 5. That means there's an option. There's a choice. It is not a must for Swiss company to take the project to 5 years. An investor is offering Swiss company 620 million. This is what we refer to as financial flexibility. that is not considered under the conventional net present value method. The cash flow from the project has a standard deviation of 36%, and the risk-free rate is 4%. Requirements. Oh, requirement is missing. Please allow me to put it there. Requirements required. Using the option pricing method, assess the financial viability of the project. If you look at the scenario, we now know that this question is trying to text option to abandon a capital project. The scenario created in this question shows that this question is trying to text option to abandon a capital project. You now ask yourself, what are the steps involved when dealing with option to abandon? Let's start here. What are the steps involved? Let's open a new whiteboard. It is better. All right, we start this question here. Okay. Company name Swiss Company Limited. We are looking at this question on option to abandon. Using option pricing method, assess the financial viability of the project. We now come here, step 1.
We don't have this question.
Yes, I know. I will reshare after the class. Is that clear, sir?
Yes. It would have been easier to be following us.
Okay, let me see. Let me see. It can be done in less than 5 minutes, sir. But I have to take this off.
No, guys, it's 5 minutes. Just continue. Cool, please.
It's already done, self. I'll just come here on my desktop. Where is that stuff on my desktop? Oh. Option theory, this is. Shared. Yeah, I've dropped it. I dropped this on the group chats. So we can continue now. So we are dealing with question on Switch Company Limited. Move to the whiteboard. Step 1. Calculate NPV without option to abandon. Option to abandon. That means the project will be taken to 5 years. We have our year 0, year 1, year 2, year 3. Year 4, year 5. Then the cash flow. Cash flow. In year 0, we have 930. Year 1, how much, please?
120.
120. Year 2, how much?
160.
160. Year 3, how much?
340.
Year 4.
310 and 440.
And 440. Thank you. $440. Then we are told that the risk-adjusted discount rate is 12%. Our discount rate, 12%. Please, can we have the discount factor for year 1 is, so year 0 is 1, year 1, 0.8, 93, 12%. Please reconfirm. Year 2, 0.797 at 12%. Year 3, 0.712, if I'm not mistaken. Year 4, how much, please? Discount rate 12%.
0.636.
0.636. Then year 5,
567.
567. We can now get the present value. This is 930 negative. Please multiply.
Okay. Year 5, 249.48.
Two, 4.48. Yes, which one is ready?
Year 4, 197.16.
197.16. Next.
Year 3, 242.08.
242.08.
Then year 2, 127.52.
Year 2, 127.58. Is that correct?
52.
52.
In year 1, 107.16.
107.16. Now sum up, let us obtain the net present value of the project. Assuming the project is not abandoned, what is the NPV of this project?
I got a negative 6.6.
Very correct. So if this project is not abandoned from year 0 to 5, the NPV will give us negative 6.6 million. Negative. NPV without abandonment, negative. You have treated step 1. We now move to step 2. Our step 2. Calculate value of put option. Option to abandon is treated as a put option. Right to sell. To calculate value of the put option. Formula for put option. Put is equal to open, capital letter E, exponential minus RT, multiplied by N into bracket minus D2, close my bracket, minus, open another bracket, SO multiplied by M bracket minus D1. Close our bracket. Our SO, that is the underlying asset price. Underlying asset price. That is the present value of future cash flows forgone. Under option to abandon, your XO is the present value of future cash flow forgone. Now, when are we going to sell these projects? Look at it.
The start of year 3.
Thank you. The company has recently received an offer from a foreign investor to buy the entire project for 620 million at the start of year 3. Under investment appraiser, start of year 3 is the end of year 2. That means we are going to commence this project in year 0. We are going to do it for 1 year, 2 years. After 2 years, we are going to dispose the project. Beginning of year 3, that means after 2 years. Under investment, beginning of year 3 is the end of year 2. So that means cash flow forgone. Look at it, please. Present value of future cash flow forgone. Let's move up a bit. This investment, the company will commence in year 0. The company will do it for first year. Cash inflow in year 1 will be received. Cash inflow in year 2 will be received. After year 2, the company will dispose this project. That means present value of future cash flow forgone. We start from year 3. This from year 3 to year 5, the future cash flow forgone, the present value. Now look at it, please. From here. Oh, I know. From here now. From here now. Year 3 cash flow forgone. Year 4 cash flow forgone. Year 5 cash flow forgone. Because we are going to dispose this project at the beginning of year 3. So we pick the present value of future cash flow forgone. 242.80, 197.16, this is equal to 242.80 plus 197 point what? 0.16. Plus 249.48. These are the present value of future cash flow foregone. You are going to sum these three cash flows. This will represent your SO. Value of future cash flow for the present value of future cash flow foregone. Please sum up.
688.72.
Correct. Our XO is equal to 688.72. We move to E, the exercise price. The exercise price is the salvage value. This is our exercise. Okay, let me write down. The exercise price is equal to the salvage value. That is the scrap value. How much is the foreign investor willing to pay?
$620 million.
Thank you. That is the salvage value of the project. We can dispose the project and collect 620 million. 620 million. Next, what is the time? When are we going to abandon this project? At the beginning of year 3. That is under investment. At the end of year 2. Our T, time to maturity. These projects will be abandoned at the end of year 2. That is 2 years. Our risk-free rate. The risk-free rate is given in the question to be 4%. And volatility. Represented by standard deviation is given to be 36%. This is equal to 0.04, 0.36. We have gotten the 5 input variables. Next, calculate your D1. Next, D1. Formula for D1, recall, A bracket XO over E, close your bracket, plus further bracket R plus 0.5 volatility square multiplied by T all over volatility square root of T. Therefore, our D1 is equal to 8 bracket 688.72 divided by 620, close my bracket, plus open another bracket, 0.04 plus 0.5 multiplied by volatility square, 0.3, 6 raised to power 2, close my bracket, multiply by T, 2 years, everything over volatility 0.36 multiplied by square root of 2. Please work this out and let's obtain our D1. What's our D1? Go to your calculator, look for in 688.72 divided by 620. Close your
118.
bracket. Finance, how do you have?
1.2363.
1.2363.
63.
Do we agree with that?
I got something different, but let me cross check.
What do you have, sir? Tell us, don't worry.
2.118.
Ah, no.
I'm cross checking.
Yeah, the correct answer should be 0.6182. Your D1 should give you 0.6182, 4 decimal places. There is a figure for D1. Once you have that,
Okay.
you move to
0.6, 0.6181. Yeah, that is correct.
approximately
Yes,
682.
it's correct. Yeah. Yes.
Good. Once you have your D1, move to D2. Your D2 is simply D1 minus volatility square root of T. This is equal to my D2 is equal to 0.6182 minus, I open a bracket for these two, 0.36 multiplied by the square root of 2, our T. Please compute your D2.
This one is 0.109.
Take it to 4 decimal places, please.
1091.
That's correct. 0.1090. Okay, you might have to share. It's very possible. A is equal to minus bracket 0.36 by square root of 2. Yeah, our D2 is equal to 0.1091. Once you have your D1 and D2, what you are required to do next is to calculate ND1, ND2 using normal distribution law. Next calculation. Calculate ND1 and ND2 using normal distribution table. Normal distribution table. I've been treating tasks today. So we'll start with our D1. Our D1 figure is 0.6182. The first thing to do is to establish a range. This figure lies between the range of 0.61, 0.62. The figure 0.6182. Once you establish your range, then take your D1. Remember the rule. If the sign here is positive, like we have here, plus 0.6182, then when you get to your ND1, you are going to start with 0.5 plus. Now open a bracket. If you have the log, let's check the log. It's also available on the material sheet. We want to check 0.6 trace to 1. Look at it, please, on your screen. I have 0.6. And I have figure up also. 0.6 trace it to 1. Look at 0.1. That will give me 0.2291. 0.61 will give me 0.2291. I have checked 0.6 under 1. I'm left with 82. I will now say plus 0.82. I will open another bracket. I will now go back to my log. Take 0.62. 0.62 will give us 0.2324. (0.2324). When you get your figure, now say minus the figure you derive at the lower band under 0.61 minus 0.2291. This is how to calculate your ND1. We can work out this now to derive our ND1. If you work this out, your ND1 should be 0.7318. Please, you can reconfirm this. When you are done with this, you move to your D2. Our D2 figure, we have 0.1091.
It's confirmed.
Thank you. Now, when you have your D2 figure, again, establish a range. This is the position of icon. A range this number 0.1091 is between 0.10, 0.11. Now move to your ND2. Bearing in mind the sign here, we have a positive sign here. 0 plus 0.1091. Therefore, I'm going to start with 0.5 plus. I will now open a bracket. Go to your log. Check 0.1. Look at it, please. 0.10. That will give us 0.0398 under my normal log. This is 0.0398 plus I've checked up to 0.10. I'm left with 0.91. 0.91. Open another bracket. Now go check. 0.1 trace to 1. 0.1 trace it to 1. That will give me 0.0438. 0.0438 minus what I have at the lower band, 0.0398. What is the ND2? Your ND2 should give you 0.5434.
That's correct.
Now, we now take one more step. So we now take one more calculation. This calculation is informed because we want to value put option. This calculation is only because we are calculating value of put options. Now come here, determine N bracket minus D1 and M bracket minus D2. Our M bracket minus M bracket minus D1 is simply 1 minus ND1. And that will give me 1 minus 0.73. Let me check, 1/8. Yeah, 1/8. Please get this figure out. That gives us
0.2682.
Then I move to N bracket minus D2. This is equal to 1 minus ND2. This is equal to 1 minus 0.5434. That gives us 0.4566. You can now calculate value of puts. Value of puts. Remember the formula? Capital letter E exponential minus RT multiplied by M bracket minus D2, close your brackets, minus bracket XO multiplied by M bracket minus D1, close your brackets. Therefore, our put value is equal to, I open a bracket, our capital letter E, 620. Small letter e, that is exponential function, minus our r, 0.04, our t, 2 years, multiplied by n minus d2, 0.4566, 0.4566. Close this, open another bracket, minus our xo,
688.72.
688.72 multiplied by 0.2682. Final answer, please. What is the put value? Put value should have 70.01, if I'm not mistaken, something like this.
Getting 76.6. I'll check it again.
What do you have?
Let me reconfirm. I'm getting 76.6.
I think that should be right. Yeah. I think it should be right. Yeah, that's correct. 76. May I've moved to the final answer. There's 76.6.
0.6.
Yeah, it's correct. And you can do it straight from your calculator. I got 76.61. You are done with step 2. The final step. Step 3 is the addition of step 1 and step 2. Step 3. Calculate NPV with option to abandon. This is equal to the put value plus NPV without option to abandon. This is equal to put value of put plus NPV without option to abandon. Our put value as computed in step 2 above is equal to 76.61. Option to abandon, option NPV without option to abandon is equal to negative 6.6. Add these two together, what do you have? That will give you 70.0.
70.
Is that not?
Yeah.
That is the value of NPV with option to abandon. If you look at it, if the project is taken to year 5, that will give us negative NPV. But if financial flexibility is considered, the project return will now becomes 70 million. So our recommendation will now be the company should undertake the project and after 2 years, abandon and sell to the foreign investor. Our comments or recommendation: the company should accept the project the company should accept the project. This we commence at year 0 and after 2 years, after year 2, after year 2, the project should be abandoned and disposed to the foreign investor. After year 2, the project should be abandoned and disposed to the foreign investor. Because you have positive 70 million. By taking that up, that will improve the project profitability to 70 million. That is how to treat option to abandon. All right. I have just like 2 minutes. Any question, please? All right. May God give us a better understanding. We shall be closing the class now, rounding up. All right, good night. If there's no question.
Good night.
Good night, sir.
Yeah, thank you.